Well, good evening, ladies and gentlemen. Welcome to our NFP Non-Farm Payroll Night Live. I am Glenn. I'm the Director of Research here at AC Capital Market. So, big warm welcome if you're first time joining us webinars from wherever you are in the world. Big welcome to you and thank you for your time. Tonight, we're going to definitely go through a lot of risk events, I think, which is the topic and what's on our radar this week. So risk events and risk management will be key to this non-farm payroll release for August. Then we're going to go through very quickly what is non-farm payroll if you're new to our channel, to our webinar series, what has been the recent non-farm payrolls and their implications moving forward for the financial markets. And as you've seen that on our poster, it says 77 record highs later, U.S. stocks face their next biggest test, which is the non-farm payroll tonight. As we know that the S&P 500 has recorded more than 77 record highs this year and 2024. So plenty of valuation froth in there, plenty of bubbles. If somebody think, in the way of PE ratio and all that valuation models, there's a lot of potential bubbles in there. And there's a lot of forward pricing as well. Markets thinking that, uh, you know, the Fed's going to cut rates, but how many cuts are they're going to be for before the end of this year, and how many basis points will there be in these cuts? And we're going to discuss that as well. Then we'll be looking at the three case scenarios. Three case scenarios I'm talking about. Basis the base scenario 25 BP cut in September the 17th. Then we'll be looking at the best case scenario. Could be a 50 BP cut delivered on the back of a solid or a resilient economic circumstances. Then, of course, the worst case scenario, what's that going to be, and how we're going to react to that, and is your risk management strategy in place should that adverse price action happens against you. All right. Then we're gonna go through all the markets on our MT5 trading platform. We're definitely going to go through US dollar. We're gonna go through gold hitting $3,553 for the first time in history. That the historical movement, we're gonna look at that as well. And then definitely we're gonna look at the three key US indices, major pairs, and whatever you might be interested in. All right, so let's dive into it. Now, let's have a look at our whiteboard. Okay, I've got this lovely whiteboard, and I apologize because my tablet is broken, so I can't really draw beautiful pictures on it. But I'll try to use my typing tool to make this as interesting and as clear as I can. All right, so what is non-farm payroll, right? Non-farm payroll is clearly non-farm payroll, and FP stands for non-farm payroll, but it essentially measures the employment status or the jobs created in the United States, excluding the farming community. All right. So if you are a farmer, you're riding a tractor, you're collecting your crops, or if you are flying a crop duster, you know, spreading chemicals and killing all those bad insects, then you will not be included in the statistics. You will not be included. However, if you're, say, you're a cashier at Walmart, if you are a mechanic working in the metropolitan area, or if you're a pilot flying a commercial airline, or accountant, or anything else outside of a farming purview, then you will be classified, your job will be included in the non-farm payroll. So it's very important. It measures a lot of people and it shows the strength. All right, it shows the strength of the labor market. Right? It shows the strength of the labor market. And when we have a strong labor market, what does that mean? That means our economy, well, at least the US economy, is doing well. All right. Strong labor market, economy is doing well. Why? Because people have jobs, and jobs equal income. Income equal spending. And that boosts the economy. All right. And that gives us harmony or merry-go-round. All right, everybody spends, everybody's got something to hold on to, and that stimulates the economy, which is good. All right, which is what the Federal Reserve wants. It's their job, their dual mandate, low inflation and a strong labor market. Two things they want to achieve. So when the net non-farm payroll is good, is running hot, chances are the economy is doing well as well. And then people are spending, right? Say the young fellas here, if you're like me, when I was younger, I was like so much into computer games. And I was like, I wanted to have a good gaming computer. Right? I wanted to upgrade my GPU. Well, how much is a GPU? Right now, it could be $1,500 for a good one. Then if I had that money, all right, I'm gonna buy it, and my money goes to Nvidia and Nvidia makes money from me, then a lot of people like me will contribute to Nvidia's balance sheet, will become their revenue and take out expenses, and they have their net income. And that net income goes into their statements. And all the analysts from, say, Bank of America, Morgan Stanley, Goldman Sachs, they see this and they go, oh, wow, the company's doing well. People are buying these shares, and the share price goes up, right? The share price goes up. Let me just type this down. When the share price goes up, I can say, boy, buys NVIDIA, all right, NVDA GPUs, all right, and then what? Then NVIDIA makes money. That money goes into their, what's that? Earnings, right? Earnings and their share price up, okay? And when the share price goes up, it also, because NVIDIA is part of the S&P 500, the S&P 500 also goes up. All right. So the stock indices go up, stock prices go up, people spending go up, and the economy is running hot. All right. That's the best case scenario here. And that's what the markets want to happen. If you're a bull, you want everything to go up, you want this to happen. All right. But has this been the case in the past several months, let's say the last quarter? No, not really. Why not? Why not? Let's have a look at our chart here. So this is from Trading Economics. Okay, you can just hop onto trading economics from Google and you'll see them. You can find this from your browser. So looking at this, we all go boom, 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 boom. Look at here. So December 2024, the non-farm payroll jobs, 323,000 were created. That's a lot. That's a lot of jobs created for December. Okay, so that's good. Market's running strong. And coming to this year, January, 110, 111,000, pretty much there for 3 months, and 158,000. But bam, May, June, really, really terrible numbers. Okay, then if we go back to our charts, you will see after the revision was done, we see the dollar crashing down really hard, really fast. Because why? Because the economy is not doing as great as they thought. So that revision was really critical to the dollar's fall. Okay. Now, when people ask me, hey, Glenn, what's the correlation between the dollar and the non-farm payroll or the interest rate? The non-farm payroll shows labor market, right? Labor market. When that is hot market, they will create inflation. Okay. So if the labor market is cool, it will cause deflation, or at least not much inflation. And we know that from the COVID and everything that happened after that, that is high inflation is bad for the economy, bad for economy, yeah. And to deal with it, the Federal Reserve needs to raise interest rate. Okay, this is very important now. You need to raise interest rate, and higher interest rate in most of the time will lead to stronger currency. All right, in this case, the stronger currency is a stronger stronger US dollar. All right. So looking back, lower inflation, lower interest rate, or what should I say, lower interest rate equals lower or weaker US dollar. So that's the price in the mentality behind what we're seeing now. Okay, so when the non-farm payroll was so weak. Now let's just hop back into the chart here. When the market's so weak right now, markets are not pricing in for any interest rate rises or hikes. Markets are pricing for the Federal Reserve to cut their rates as quickly as they can because they need lower rates for the business to get back on their feet again and they can resume hiring, right? And with the lower interest rate priced in, the US dollar crashes. Okay, US dollar crashes, and it gets stuck in between this range since early this month. All right, well, last month, August, should I say. So the lower rate, lower dollar. Okay, weaker dollars. A higher rate, stronger dollar. That's the case for now. All right. Now you've understood what's causing all of this drama, this fuzz. Let's look at what people are expecting for this particular NFP tonight. For this particular NFP, people are expecting what the consensus. Our consensus are groups of economists, the different organizations interview. I get interviewed sometimes to share my opinion on this as well, and they get published on the mainstream financial media. All right, so let's look at this non-farm payroll. Right, previous 73,000 consensus. All right, that's the estimate. All right, estimate for this time is 75,000. Okay, so slightly higher than last time. Last time here, 73,000. This time we're expecting 75,000. Okay, 75,000. Slightly higher than last time. However, the unemployment rate is also crucial to this. All right. So previously in July, the unemployment rate was 4.2%, which is okay-ish. Okay. However, this time it could tick up to 4.3%. All right, forecast, all right, 4.2, 4.3. All right, so getting back to our whiteboard, our blackboard, whiteboard. I like to call it blackboard, but it's actually a whiteboard. So getting back here, there are well, I mean, two key numbers to watch tonight. Now, I apologize again if you just joined me here. I will fix my tablet. I'll use my pen to write. It will look a lot nicer, and we can draw some interesting interactive pictures and to demonstrate, to further elaborate our strategy, the formulation of our strategy. But tonight we're going to look at two numbers. One is the non-farm payroll number, our number. So number of jobs created in August. That's the first thing we're going to look at. Second thing, we should do this. One second thing is unemployment rate. Okay. And this will give us, no matter how the numbers change, they go higher, they go the same, or they go lower, it will give us three outcomes. Okay, three potential outcomes. Now, this is the very important part of this webinar. As a market analyst, if you are one, if you want to be one, if you were one, okay, if you know somebody that is one, uh, the way we price and the way we forecast is through this model. Okay, it's a scenario-based analysis model. We'll look at first of all the base case scenario. Okay, base case scenario. All right. Then we'll look at the best case scenario. Oopsie scenario. Then last of all, we're gonna look at the worst case scenario. It's weird spelling. I hate this word. Um, so three cases of scenarios. The first case scenario is everything goes as planned. Now, what does that mean? Yo, Glenn, what does that mean? Everything goes as planned. Explain to us. All right, I'll explain this. Let me switch back to my desktop right here. The base case scenario is when the Federal Reserve on the 17th of this month will cut 25 basis points. All right. So what's the current interest rate? The current interest rate is 4.25 to 4.50%. All right. I go, wait, Glenn, why is that a range? Should the interest rate be just that fixed number? No, the Federal Reserve actually gives a range. Okay, so it can fluctuate in that range. That's how the funding rate works. All right. So don't worry about that. If you think it's too difficult to memorize, you just remember the higher one or the lower one. Okay, so 4.5, you can go just 4.5 or 4.25. All right, so that's the current range. So the market participants, according to CME Group, they do their data collection and they price this. They do an analytics, and they have this very how should I put this? The markets are moving based on largely based on their estimates. Okay, so 0.6%. That's a very tiny probability that the interest rate will stay the same. That means here, okay, if you're looking at here, that means this there's a chance of 0.6% that the Federal Reserve will not cut or hike. Okay, they just sit down, they just cross their arms, they go, nope, nothing. Okay, that's 0.6% chance. That's very tiny. However, if we look at this massive blue stick, you will see that the rate under here is 4.0 to 4.25%. So that's a 25 basis points or 0.25% difference between these two candles. That means the probability for the Federal Reserve to cut 25 basis points is 99.4%. So it's very likely to cut 25 basis points. All right. So this is what we call the base case scenario. Let's jump back to our whiteboard. So the base case scenario, where's my whiteboard here? Okay, base case scenario is Fed cuts 25 BP, smiley face. Okay, 25 BP, everybody's happy. Nothing goes wrong. All right, this underlying meaning is that nothing goes wrong. Phew. Okay, cuts 25 BP. That's base case scenario. Why do we call that base case scenario? Why base, right? Why base? Because everything has been priced in. Meaning, all the prices we're seeing right now, whether it's US dollar, whether that is euro versus dollar, whether that's the indices, whether it's the gold, silver, whatever, the price here is based on the 25 BP cut. Everything is okay. All right. So if it really cuts by 25 BP, then there's not much we can do. Right. Price is small fluctuations, small movements. You can scoop, you can scope, you can do a short-term volatility trading, but not much you can do. All right. So we move on to best case scenario. Everything goes above base case. Okay, so it's slightly better everything. That in that case, the Fed cuts 50 basis points. Wow, that's amazing. 50 BP. Under what circumstance would the Fed cut 50 BP? That's the question. The question, the answer to this question is when NFP shows significant weakness. Okay, so if the NFP, now we know that the NFP is 75K, 75,000 for August the estimate. Okay, 75,000, and the unemployment rate is at roughly 4.3, 4.2, 4.3%. Okay, so this is based on lower number or reading than 75,000 and higher unemployment rate than 4.2 slash 4.3%. All right. So something goes wrong, but not terribly. Excuse me. So something goes wrong, like my voice, but not terribly wrong. If it's terribly wrong, I can't go on. So if it's terribly wrong, then the markets will crash. Okay. So something goes wrong lower than the estimates, but the Fed is still okay and it doesn't go so bad, it causes a panic and sell off. So the Fed cuts 50 BP, then everything goes up. Markets are happy because the cost of funding is lower. With lower interest rate, companies enjoy more profits. more net profit, and they will push up prices. All right. So that's the best case scenario. 75,000, lower than 75,000 employment numbers, higher unemployment rate, but not too much. All right. That's the best case scenario. The worst case scenario is everything goes what? Goes horribly wrong. That is also that also opens up the Fed cutting 50 BP, but causes a panic. That is when does that happen? That is when NFP shows also significant weakness, but much lower than estimates. All right, so that'll be the worst case scenario. So going back to review this, we're sort of running out of time. I've just typed too much, but let's go back here and review this before we jump in our MT5, MT4, whichever you're using, before we really try to look at the price levels. Let's review the three case scenarios. The best case scenario is when everything goes as planned. The Federal Reserve cuts 25 BP. Everybody's happy. Nothing goes wrong. Okay. Second scenario, which is the best case, everything goes above the base case. All right. That doesn't mean the numbers go up. That means the basis points of cut goes up. When would that happen? That happens when an FP shows significant weakness that is based on a lower number reading than 75,000, higher unemployment rate. Last, the worst case scenario is everything goes horribly wrong, Fed cuts 50 BP, but causes a panic. That is when an FP shows significant weaknesses and but much lower numbers than estimates. So we could be looking at 12,000 or 22,000 in employment. Sorry, in the jobs created. We could be looking at 4.4% in unemployment rate. So that's really bad. All right. So with these three scenarios in our head, let's go to look at our MT5. Now, this is the dollar index, DXY. And I love this. DXY is a basket. All right. It's not one single currency. It is the dollar against the basket of six currencies. So it shows the general strength of the US dollar. Let's look at this. So the dollar has been the dollar index, I'm sorry. The dollar index has been trapped in this range of 97, 557 or 5570 and between that and 98, 5140. Okay, so between this range has been fluctuating. And the reason for this fluctuation is because markets are pricing in for the base case scenario. Everything's priced in, not much to do here. So just small volatility, small profit taking, small plunging, bring it back up again. Now, with this case of scenarios, with this kind of price movements, we'll talk about volatility trading strategies next time. I don't think we'll have time for this, but keep this in your mind. If you got pen and paper, write it down. And if I forget about that next time, please do remind me. This is a very, very good trading strategy. I love it so much. Okay, so dollar, as we can see, not doing much here, fluctuating, not much here. But if we think back to our second scenario, which is the best case scenario, the Fed cuts 50 BP when nothing goes wrong. Right? 50 BP cut, nothing goes wrong. Then what's going to happen to the US dollar index? Will it go up or go down? Well, surely it will go down because the lower the interest rate, the weaker the currency in most cases. Okay, unless it's extreme case. So lower the rate, 50 BP drop, lower the currency. If they do cut by 50 BP, you will have this thought in your head. You should have this thought in your head that the dollar is very, very likely to go lower. So don't go against it, right? It would be quite extraordinary for someone to tell me, "Hey, Glenn, I think I'll go long the US dollar right now." Because why go long? He or she must have a very solid reason for doing that. Right? A very solid reason for doing that because we are now in the middle of what? An easing cycle. The Federal Reserve has been cutting rates lower and lower. The problem or the question is not whether it will cut, but when and how many basis points will it cut. That is the key for this to happen. So don't think that I'm gonna go hike, I'm gonna go long the US dollar, okay? This is not a financial advice, but I'm sharing my personal view on this. Now we look at a few other let's look at gold next, right? Gold has been going strong, right? Gold, if you go back to the end of here, which is the end of 22, okay? 22, it's been going up, right? That was the end of the super inflation bubble. But the real trigger for the for gold's magnificent bull run, I call it that, is by the end of 23, okay? October the 8th, you know, that political geopolitical crisis happened in the Middle East. And since then, the gold price has been going higher and higher and higher. Now, during this, there are a lot of reasons driving that, right? There's a geopolitical reason. There is the Federal Reserve cuts, the projection of cutting as well. And there's also the People's Bank of China resuming the quota, sending, essentially saying that, hey, commercial banks, please go ahead and stock more gold. So this is big central banks buying gold. While supply remains constant because only so much gold under our feet on this planet, demand rises, especially from central bank deep pocket buyers. That sends our gold prices higher and higher. All right. However, if you look at this Darvas box pattern, which is very similar to the US dollar we just looked at, this area is critical as well because since April 21st till maybe just last week, all right, it has been trapped in this range. Now, that's telling me there is no reason for the price to go higher. No reason to go higher. The only reason to There are two reasons that power the gold from going higher. First of all, is geopolitical reason, which we just talked about. Second reason is the strength of the US dollar. All right. Strength of the US dollar, that means if the dollar is going higher, then gold is going to drop. If the dollar is going weaker, then the gold will likely go up because it is priced in US dollars. All right. If your dollar is worth more, then you have to spend less money to buy the same amount of gold. If your money is worth less, you have to spend more money, which means that the price of gold will go up. Now we're seeing this breakout of pattern. Okay. Key is here. We're seeing the breakout of this pattern. A few days ago. The gold breaks out of this box and now hitting 3,575. Now the city says 3,600. Okay, their target price 3,600. Goldman Sachs released a report this morning saying $4,000 can be reached, even 5,000. Okay, that is very aggressive. Right? That estimate is very aggressive, but we need to understand the reason behind this. All right, so dollar strength is key here. Geopolitical variables pretty much there. All right, unless another major conflict breaks out somewhere in the world, it's basically here. All right, so I'm not expecting much to happen on the geopolitical front. I'm expecting more to happen on the dollar strength. So if the dollar is priced, I mean, Federal Reserve cuts 25 basis points, then it's probably going to stay somewhere around there, 3,550, 3,540, somewhere around there. That's priced in. However, if you think about for gold, the best case scenario is not 50 BP cut plus everything goes okay. Why? 50 BP cut, definitely good because it will make the dollar weaker. All right. Gold is supposed to go higher when they cut 50 BP. That's a lot of cut. But if everything's okay, then there's no panic. Gold is a safe haven asset. Don't forget, ladies and gentlemen, when market goes wrong, when something goes terribly, terribly wrong, gold will become the place to park your cash. All right, doesn't drop in value. So the worst case scenario we spoke about, this one here, worst case scenario is actually the best case scenario for gold. Everything goes horribly wrong. 50 BP cut right here. All right, 50 BP cut. Oops, where's my laser pointer? Oops, oops, oops. Come on, laser pointer. Okay, here. 50 BP cut makes the dollar weaker, causes a panic. A panic is very important and horribly wrong. That will send gold prices higher. Okay, so if you're a gold trader, you will want If you're a gold trader, you will want this to happen. Okay, if you want to go long gold, you want this to happen. If you're an equity trader, what we call this a risk asset trader, you're going long those assets, you will want this case scenario. Okay, everything goes above base case, but 50 BP cut and that big smiley face. If you're not trading, if you have like assets that you've already bought outside of the other side of trading, you probably want this one. Everything is calm, everything is okay. Let it go through, cruise smoothly. That's probably something you want. But if you want these two, yeah, we'll keep our eyes open for what's about to come tonight. But then I hope despite the limited time, I hope I have given you I've built up the mentality of your mindset to navigate the non-farm payrolls, not just for today, but also for the days, the weeks, the months to come, for non-farm payrolls, for PMIs, for CPIs and PCEs, all kind of data. There will always be three or sometimes four cases of scenarios, and you will formulate your strategy based on the probability of these events happening and their implication. Is going to send my asset prices higher or lower? Then you can set up a risk management strategy. Or even if you're an aggressive trader, short-term trader, you place your bets aggressively. But you need to know, right? Knowing that you know, I always say this to my clients, to say this to my colleagues, knowing that you know is the first and most important step towards being a successful trader. All right. So thank you so much for coming today. Unfortunately, I have to wrap it up now. If you have got questions, please feel free to send to your client managers, your point of contacts, and they'll just say that send it to Glenn, and they'll probably send it to me. And we're going to put this recording on our official website and on our YouTube channel. So if you're watching this from YouTube, this replay, please drop your comments there. Tell me, Glenn, I want to know how the pricing works. I want to know how to do regression analysis. Okay, I love this geeky stuff. Excel sheets. You can tell me this stuff you want. How do I interpret the financial statement from Nvidia, from Procter and Gamble? We can do that as well. All right, we are the research department. I'm in charge of this, bringing you. I'm responsible for bringing you quality contents. And next time we meet, I'm hoping that my tablet will be fixed and we can draw and make more interactions in there. So thank you so much for watching. I wish you good luck in trading and have fun doing that. Then yeah, well, we'll see you next time. Good night.